Good afternoon, ladies and gentlemen. Thank you very much for waiting. We'll now start our panel discussion entitled Blended Finance at Work in Emerging Asia. To start off, we'd like to welcome the CEO of FASP Office, Mr. Munib Madni, to give us the opening remarks. Munib, please.
Hola, good afternoon everyone, and so sorry we are slightly late, caught up in a meeting there. On behalf of Singapore Financing Asia's Transition Partnership, FAST-P Office, the initiative, our partners, a big welcome to all of you to our home away from home, the Singapore Pavilion, and to the Blended Finance panel that we're having today. My name is Madni, and I have the privilege of being a team member of FAST-P, and our task is to make sure that FAST-P delivers on the initiative's ambition with our partners. So before we get into this, I just want to ask, can I get a show of hands for all of you? Is this your whoever has the first COP, the privilege of this being their first COP? Show of hands. Oh, wow. Not many. You're like me. This is my first COP, a confession I have to make. And it was not because of a lack of interest that I wasn't or have not been here. It's more because I've always had deep respect for COP, what COP is all about, what people do here. And I've never felt confident that I could actually contribute until today. So I'm hoping today what you hear from us and the panel today, even if you get each one of you one aha moment or one point that you will walk away with, I think I've done my job and deserve to be here. So that's something that I'm looking forward to. Now, can I also get a show of hands for those who were at Dubai at the Singapore Pavilion 2 years ago? Okay. So the good news is, and congratulate yourselves for this, that that was when FAST-P was first announced, and also all of you are FAST-P OGs. So give yourself a bit of a clap that you are part of the history of FAST-P. For those of you who are new to FAST-P, let me share a little bit, and if you were not here earlier this morning when Ravi was giving you a description, this might be helpful. So FAST-P is an initiative set up by the Singapore government. It's a blended finance initiative. The Singapore government has put $500 million into this initiative, and with the help of catalytic commercial partners and our fund managers, we intend to deploy $5 billion in transitioning of Asia and funding and financing of the transition of Asia. And that's what the whole purpose of FAST-P has been from its beginning. Now, 2 years ago, for those of you who were here, you would have seen the announcement. There was an MOU signed by Temasek, IFC, Allied Climate Partners, and MAS. And that was the origins of FAST-P. Fast forward now, we have a fantastic cohort of transition finance change makers, and all of them have done a fantastic job of taking FAST-P to where it is. So 2 years ago, we gave you an idea. Now we're going to share with you the execution of it. 2 years ago, we actually, with our partners, gave you a promise. Today, we're going to share with you how that promise has actually turned out in delivery terms. 2 years ago, we had an ambition. Today, our fund managers are going to share with you how there have been challenges and how we've come up with actual solutions for that. And 2 years on from Dubai, now at this implementation COP, I'm hoping that you will find a lot more and an update on FAST-P and what we have achieved. But before I go into that, the other reason why I'm excited about today is that we actually have the privilege of having three of our investing partners, three fund managers with us. If there's one thing that makes FAST-P, or gives FAST-P its power and also its pace and its speed, it is our investing partners. As a blended finance platform, we enable our investing partners to actually create blended finance structures, but with the ambition, the same ambition, and that is to decarbonize and help Asia transition. The FAST-P initiative has already identified three focused areas of decarbonization in Asia. And we've been very fortunate that we've also identified three portfolio managers whose wheelhouse and expertise is actually deploying in that space. And today you will get to hear more from them as well. The first pillar, which we call the Energy Transition Acceleration Finance, ETAF for short, this is managed by Clifford Capital, and it's going to help us scale up green energy to replace high-emitting assets such as coal, and that's where the conversation inside was happening, all about coal. With our funds, we hope to finance green alternatives to remove, replace, and even displace coal and diesel generation and introduce green electrons into the grid. Here, Clifford Capital focus will be on mature operators, grid companies, and coal power companies as well. Today, we have with us Vid, the CIO of Clifford Capital Asset Management, to share with us. Welcome, Vid. The second focus area for us is the Green Investment Partnership, what we like to jokingly call our GIP versus BlackRock's GIP, which we will get to. This is managed by Pentagreen Capital, and it will help scale up green and sustainable infrastructure with a focus on the mid-market developers, broader sustainable infrastructure builders, such as biomass energy providers, greening and FMCG supply chain in Indonesia. If you had followed FastP, you would have heard that 2 months ago, Green Investment Partnership had its first close. It had a $510 million first close, which we were very proud to be a part of. FastP contributed to it. But it was more also the partners that came along with us. So we had BII, EFA from Australia, FMO, IFC, ACP, Temasek, HSBC, and BPI, a local bank in Philippines. So a fantastic support group for our Green Investment Partnership. From Pentagreen, we have with us Varad Zavarov, and we're happy to have you here with us. The third pillar is the Industrial Transformation Partnership. This is managed by BlackRock's GIP team. This will help us scale up financing for private sector borrowers seeking to decarbonize their businesses, including industrial opportunities, technology solutions for decarbonization, and projects in hard-to-abate sectors. The most obvious example of this being steel or mineral processing plants and operators needing finance to decarbonize. From BlackRock, we have Matt Kazmarek with us. Welcome, Matt, to the FastP panel. Before we get into this panel discussion, I do want to say that one of the things that gets the FastP office, our partners, really excited and confident about what we're going to do and how we're going to succeed is that we've been blessed with a visionary leaders who, from the very beginning, helped in ideation to implementation. While we've had some of the successes, we've got some really good momentum going forward, we still need them. We still need them to give us the energy, the direction, and support. I'm glad to announce that we are setting up an international advisory board, and I am even happier to announce that one of the visionaries and the drivers of FastP from the times he was with MAS, Ambassador Ravi Menon, has graciously agreed to be the chair of our advisory board. We're going to be in good hands with him steering the ideas and implementation of FastP. So with that, I'm going to invite Ambassador Ravi to say a few words before we get into the panel. Ambassador Ravi.
Thanks, Munib. Well, I think the people you really want to hear from are the fund managers, so please grill them with questions on what they're doing, how they're deploying their monies. I thought I'll just, Munib has covered really the evolution of FastP and what we're trying to do quite well. I just want to emphasize a few points that I think bears keeping in mind. Blended finance is not a new idea. It's been around, it's been tried. It has been said to work in a very narrow sense, has never been scaled, and sometimes it doesn't even work. What is different about FastP is that the concessional capital or the catalytic capital that sits at the bottom of the capital stack is truly catalytic. It has first loss absorbency. The many examples that we see of blended finance structures is where there is a layer of concessional debt provided by some public bodies, and debt means it has to be repaid. Of course, repaid at a much lower interest rate, sometimes close to zero, but it has to be repaid. There is an obligation. Debt sits higher up in the hierarchy. So if concessional debt is at the bottom, your capacity to crowd in more private capital is quite limited, because the question every investor is going to ask is, if something goes wrong, who's going to absorb first loss? Where's the equity in the structure? When you have a structure, financing structure with no equity or very little equity, you can't leverage. Then you are entering a very risky business proposition. And I think from day one, that was the central thesis of FASP. When we discussed it within the Singapore government, if we want to put money to help decarbonization elsewhere, what is the best way? You rather give a smaller amount of money that is like a grant, which has equity-like properties and can absorb first loss, than give a lot more money where you expect to get it all back, concessional debt. So that's the proposition we made for $500 million for the Singapore government to put this money out. So the ability to absorb equity risk is critical. The second point about FASP is what then is our KPI? And our KPI is really how much more commercial debt we can multiply into. And we set a target of four times, which we achieved in the first close of the GIP. My challenge would be we need to do better. As we get better at this, and as we build more confidence that the FASP structure works, we should aim for higher multiples, crowd in more than 4 times, 5 times, or 6 times. Because we would have demonstrated in the choice of projects that we can deliver returns as long as you have this equity layer below. So I think that is an important KPI. And of course, the other KPI is we want to maximize the reduction in carbon emissions. I mean, that's what we are in this for. It's not just to invest in a climate project and make money. It is to do that and at the same time to see how much we can reduce emissions by. So that is important. So for the money we're putting in, how much carbon emissions have we succeeded in reducing? Which means looking for projects that are difficult, which is why their job is so difficult. It's easy to find projects that can pay a good return, are low risk, and are actually considered climate friendly. But have you maximized additionality? So one of the key things that we look out for is additionality. We want to reduce emissions where it would otherwise not have been possible. So they cannot go and pick an easy solar plant in a very sunny place with a very good grid line. That doesn't need FASP money, right? Look for projects where it would not otherwise have taken place and you achieve real decarbonization. Then your money is worth it. You've done something for the planet. So I think these are some of the key things that we've done. And the third thing about FASP is that why it is different from others is that we're doing this at the program level. Now there are a few others who are doing this. Altera Fund is a good example, JETP, and we have a few other examples that are not doing this. So this is a great learning exercise. Don't try to blend capital at the project level, because if you have 10 capital providers, there's a negotiations, everyone has their different expectations. Getting consensus just to do one project is not the way to go. We're doing it at the program level. So these guys do it at the fund level, and at the program level at FASP, Munib would set the parameters, and all the negotiations take place at the funds. Because once the funds are set up, then these guys are free to actually go and invest in projects. Of course, they have to keep the investors posted and informed, but they don't have to argue over every single project. So doing this at the program level is so much more efficient. And so this is another distinguishing feature of FASP that gives us confidence that it will make a real difference. So maybe with that, I'll stop. And I think you were all waiting for the panel discussion to quiz our 3 fund managers. Thank you very much.
Thank you very much, Ambassador. We'll now move... Sorry, Munib has a few words.
No, in haste, I forgot to introduce the main person who's going to bring the aha moment out. Our moderator for today, Pande at BCG, is Varad Pande. We're really happy to have him moderate us, and he's come all the way from Singapore just for this. So come.
So for now, we'll move on to the panel discussion. We have Varad Pande as the moderator for today's session. And then with Munib as one of the panelist speaker. Next up, we have Vid from Clifford Capital, and then Marad Zaparov from Pentagreen Capital, and last but not least, Matt Kazmarek from BlackRock. Over to you, Varad.
Thank you so much, and thank you everyone for being here, and to Ambassador Ravi for, at some level, making our job easier by answering the questions, but also raising the bar. So I don't know whether it's made our life easier or harder, but we'll figure that out as we go into the details. I also realize we have prime time slot, day one of this momentous climate summit. And maybe just to start, I'll quote something President Lula said yesterday at the Leaders Summit, which I thought was quite inspiring. And he said, and I quote, "Among the indigenous peoples who inhabit the Amazon, there is a belief that it is up to human beings to hold up the sky so that it does not fall upon the earth." I hope this summit helps us push the sky up even higher and to broaden our vision beyond what we see today. So no pressure, guys, but let's make this session count. We've already had the formal introductions to all of you. So maybe something that the audience doesn't know about you. Maybe I'll pose two very rapid-fire questions to you. And Matt, we can start with you. One, tell us about your favorite myth about blended finance and what you do to bust it. And second, tell us about yourself. Is there something about you that we would not find on LinkedIn? And
Thanks.
We can go around this.
Hi, everyone. Matt Kasmerek from BlackRock, Global Infrastructure Partners. Our infrastructure business at BlackRock. Is wonderful to be here, and thanks for coming to our session. Something people don't know about me is that in a prior life, I worked in the public sector, and I was actually the chief of staff of the White House office in the Obama administration that was coordinating our positions on the Paris Agreement. And so to see what we were able to accomplish in Paris, the journey that we've made since then, and to see this spirit of collaboration and the partnerships we're building across these three strategies is a continuation of that same approach that I'm enormously proud and grateful to be a part of. So thank you. My favorite myth about blended finance is that blended finance uses public sector capital or mission-driven capital in order to enhance the return for private sector investors. And that is true in some cases, it's not true in most cases. So in our strategy, for example, our overall goal is to mobilize investors who would not otherwise be present in emerging markets to make those initial allocations. And the best way to do that is not to provide an artificial return that can't be sustained without the public sector capital, but to mitigate the risk so that investors feel confident and comfortable making that initial allocation that they can then scale over time.
Thank you. Marat?
Good afternoon, everybody. I'm Varad Zaporov, Pentagreen Capital. In terms of myths of blended finance, I think, well, the point around whether blended finance itself is just an idea and has not been implemented and is not being implemented, I think that is being busted already. The follow-on myth that always comes up is that in Asia infrastructure, there is no pipeline. And I would say the pipeline is there, the pipeline is strong. Once through blended finance, you're able to form the capital pools that can take advantage of that pipeline and actually channel capital into that pipeline. The deals are there. As Pentagreen Capital, just within the last month, we signed a transaction that will finance over 1 gigawatt of renewable energy in the Philippines. We're signing another transaction in about a week's time to finance in Indonesia portfolio projects. So the pipeline is there. What blended finance enables you to do is to create the right pool of capital that can channel funding to that pipeline.
Thank you.
And well, second question, the LinkedIn question. This was, I have to confess, a tough question. So I had to consult two sources. One is my partner, who had a view on this, and the other one is ChatGPT. My partner, she told me, well, you bankers, the unfortunate consequence of your job is that most of your personality is already on LinkedIn. So it's a bit too tough to find what is not. And when I consulted ChatGPT suggested that the other 10-20% of your personality is on an app called Strava, which is an app for the weirdo runners, triathletes, and cyclists, where we like to pour over heart rate stats after each time we go outside and turn on our watch. And we have a saying in this strange world that, well, if a run is not on Strava, did it even happen? So I might suggest that if a panel is not on LinkedIn, did it even happen? So do post all your pictures, do like, and do share what is going on here.
Fantastic. We're learning a lot already. So Vid, over to you.
Yeah, good afternoon, everybody. So I think I'll pick up on one of the things that Ambassador...
Closer to the mic.
Yeah, I think one of the things that Ambassador mentioned on the scalability of blended finance. So I think the way we address scalability is not necessarily always seeking more and more and more catalytic capital, but trying to bring down the need.
That's rain.
Okay.
It's rain.
Okay.
So we'll just have to speak louder and raise our ambition.
Sure. So I think to try and reduce the need for catalytic capital by increasing the multiplier. Again, as Ambassador said, the idea is not to scale blended finance. The idea is to reduce the need for blended finance over time through de-risking and mobilizing institutional capital. On LinkedIn, so yesterday, or actually last week, we discovered that I was doing political reporting around the same time as Matt was campaigning during the Bush-Kerry election. So my career, if I wasn't this, would have been either a reporter or writing screenplays. Yeah.
Let's try to be let's try to be very close to the mic and project ourselves.
Okay, so this is going to work or not going to work. So if any of you are going to be lip reading, ain't going to happen because this is up my nostrils. Okay, first of all, what the question was myth. So the myth that I want to bust, or FastP wants to bust, and that is that it is easier to muster a Kindle of kittens than to get catalytic capital providers to sign to one LPA. So all you catalytic capital providers out there, this is a message for you. We're going to get you there. On LinkedIn, I'm tone deaf, but I've performed twice at the Singapore Amphitheatre in a band, and I felt sorry for the crowd that was listening. So that's not on my LinkedIn.
Fantastic, fantastic. And I'm sure lots of interesting fodder which the audience would love to engage with you later. And let's now get on to our discussion on your funds. So I think just to say big picture, I think many of us would agree here that the battle for climate action will be won or lost in Asia. And I think that's what makes this so inspiring. So as, of course, Asia has a lot of problems, and it has a massive climate finance gap. The IMF estimates it to be about $800 billion a year. So that's our challenge. But Asia also has a lot going for it, right? We have a huge demographic dividend in many of our countries. We have great financial hubs like Singapore. We have a manufacturing hub beginning to emerge in many parts of emerging Asia. And of course, we have an addressable market that is really huge. Some of our estimates show we're looking at about $1.6 trillion of addressable market by 2030 in just energy, infrastructure, and agriculture. So there's a lot to go after, links to, Marat, your point on the pipeline. So in some sense, I guess what we can say is that, while the world talks about a poly crisis, Asia is sitting on a poly opportunity as an opportunity. And in this context, I think blended finance is such an important unlock. We've already heard the case being made here. And by the way, I did some Google trend analysis before this, and the word blended finance shows up 10x more now than it did 5 years ago. So clearly there's something about the term that's catching on, and it's capturing the imagination of a lot of people around the world. But the reality also is that the ambition far exceeds the action right now. Convergence, which maintains the most definitive data on blended finance and reports these numbers annually. If you see that data, the blended finance deals in South Asia and Southeast Asia, where most of you are focused on, has hovered between $3 to $7 billion a year over the last 3 or 4 years, and not increasing. There's no secular increasing trend. So we have a problem to solve. And so today we'll try and understand how we can move from that very high Google trend score to actually dollars on the ground. And maybe Munib, starting with you and building on what Ambassador Ravi said, FastP was designed to be a platform, right, to mobilize $5 billion for Asia's transition. Its audacious goals ever since Dubai have captured the imagination of both investors and the development community and the climate community. So, and we know a lot of thoughtfulness has gone behind its design, as Ambassador was mentioning, but help the audience understand a little bit more on the unique features of FastP and what makes it truly unique.
Sure, thank you. So, Ambassador Ravi did share with you some of the broad features, but I think the beauty is in the architecture, into the details. When we go into FastP, you realize that it was very, very well thought out, keeping in mind that the partners that need to be scaling up and bringing capital, like catalytic capital providers and commercial or private investors. So and at the same time, we are investing in our region, within our neighborhood, and so therefore we also need to be sensitive to investing in our neighborhood from a political perspective as well. So with that in mind, if anyone who's again followed and knows FastP, you would know that the $500 million that Singapore has allocated can first and foremost, it can only be invested in funds. As Ravi said, it is not going into project by project. So that in itself ensures that they will be scaled up. Secondly, there's a one-for-one matching with concessional capital owners. Now that really helps because all your concessional capital providers, catalytic capital providers, don't see you as a third-party, let's say, consultant or a platform that is not putting your money where your mouth is. We are actually putting our money where our mouth is in terms of catalytic capital. To also make sure that the commercial folks don't think we're having a double sort of or blending our returns, we will not invest in the commercial side or the mezzanine side. We will only stay on the catalytic side. That also ensures more private investors can come in, and that the blending is truly, you could say, the mobilization is true and authentic. And the other thing, obviously, we do is we provide the good name and reputation of the due diligence that would go into any kind of additionality, ENS frameworks, and various other governance structures that our fund managers put in place. So that again is part and parcel of the architecture of FastP. So that is very much at a very high level. I think the uniqueness truly comes by these gentlemen and their organizations sitting next to us. One of the things that we realize is that while we are, and many other catalytic capital providers are very good at knowing the catalytic and impact nature of what their money needs to do, we are not very good at going to private, whether it be insurers, banks, pension funds, endowments. We do not speak their language. We need folks who actually can speak their language to show them what is the actual blended return that they are getting. And that is why the unique feature is that get really good fund managers who know what they're doing, let them actually go and energize the private sector and bring them into it. So these are two, you could say, very high, and then on the ground operational level, unique features that we hope they're very easy to replicate. We hope there are other FastPs that do the same and do it very quickly.
Thank you, Munib. And I love the way you have thought about because there are catalytic providers and there are catalytic providers, right? So I think the thoughtfulness which has gone into it is really impressive. Maybe getting into the funds and the pillars now. Marat, maybe to you first. You guys have obviously been the first out of the gates on FastP. Congratulations. You have already completed, I believe, 3 transactions, including the one signed last week or week before last in Singapore on the Philippines. Which itself is a very unique deal, I think, aiming for 24/7 solar, a first of its kind for the Philippines, but also a role model for the entire region. And you just mentioned a 4th deal might be imminent. You have a really diverse cap table, I think, which would be the envy of most people in the investing world. IFC, FMO, HSBC, Temasek, BII, Allied Climate Partners, Bank of Philippines Islands, Allied Climate, Export Finance Australia, and EC, and I'm sure I've missed a few. But I think just to say, give us a bit of a blow-by-blow account on the journey so far and what you've learned.
Indeed, it's been a journey, and in fact a journey through also a couple of COPs where we've had to shout over bigger sound systems in the next door pavilion. So here the rain is no barrier to us telling the story. Look, I'll wind things back. Initially, the whole concept that Asia green infrastructure needs some kind of a blended finance approach that was born out of, it's now, about 3 years ago, it was born out of a conversation that the two head honchos of our shareholders from Temasek, Dylan Pillay, and from HSBC, at the time, the group CEO, Noel Quinn, where they decided to come together and join hands and create a vehicle for Asia green infrastructure. There was already a thought process at the time that ultimately there needs to be a blended finance approach of some form in order to really crack the issue of unlocking capital flows to that area. Why? Because this area and this particular part of the market in that region has, well, a number of risks. Some are real risks, some are perceived risks, and therefore some kind of de-risking mechanism is required. Back then, there was none of the design and none of the conceptualization exactly how this kind of de-risking will take place. That came much later through the work and the inputs that were provided by what is now the FASP office, and of course colleagues by the MAS and the vision of the senior leaders at the MAS and other Singapore stakeholders. But this thought process was there already. As Pentagreen, we move forward to validate the thesis and look and determine, is the pipeline really there? Is this really a valid problem statement to which capital can flow? Capital can flow profitably, where returns can be made in spite of what the market might think. And so we proceeded on that basis, generating the pipeline. Therefore, ultimately, when a number of these thought processes started to move forward within the MAS, within Temasek, it was quite natural, and we're very fortunate to have had the opportunity to contribute to those thought processes. So working very closely with our colleagues from the MAS, from Temasek, what is now the FASP office, to look at the kind of capital stacks that are required and that will be very powerful to channel capital to this opportunity set. Of course, this is moving through the number of COP-related milestones where early MOUs were signed in Dubai, and really then the work in earnest to formulate the capital stack and to bring the partners that you just described, IFC, BII, Australians and many others together. That work really only started in, well, from memory, early 2024. Through 2024, of course, detailed work on the structure, the documentation, the alignment of all the partners, and ultimately the objectives that the partners want to achieve out of the program. The way the partners formulate the objectives, because often language that matters. We all speak a slightly different set of terms. We might mean that we want to achieve a similar set of outcomes, but the way we describe those outcomes is quite different. So that alignment is absolutely non-trivial. That alignment, as expressed through a set of documents that creates a transaction, that is not a trivial exercise. So that took a number of months. And now look, fast forward through all of this. Towards the end of the summer of 2025. So that's what, probably 18 months, 16 months, 18 months. The construct, the strategy is ready to deploy capital. Only a month later, a transaction is closed, is signed, using that pool of capital. As I mentioned, indeed, next week, I believe, or if we're lucky at the end of this week, we'll sign the 4th transaction that this initiative will generate. So what I think that underscores is that blended finance is, I dare say, real. Transactions are happening. Not only projects are being financed, the constructs are being funded. Yep. Partners are coming together and finding the right kind of construct where these kinds of partners can collaborate. Commercial, philanthropic, catalytic, represented by various sovereigns, and of course the MDB DFI world. So there are constructs that get transacted and then are ready to deploy capital to some very impactful projects around the region, including the ones that we are financing.
Fantastic, and I think you're such an important case study for this whole, the thought that we have to move from ambition to action. And it was really nice to see how you have spent the last 2 years really going about this like, I think, in a very workman-like approach to really make this work, not at that 30,000 feet level, but the nitty-gritty and really showing that that's possible. Vid, maybe I'll come to you next. You are tackling a very important issue around energy. And emerging Asia faces a unique trilemma, energy trilemma, right? You need to increase access to energy, you need to bring down the cost to keep it affordable, and you need to green it at the same time. So this is not easy. And of course, the advent of AI now means that energy demand scenarios are changing quite dramatically, including in Asia. And in this context, ETAF has identified the managed phase out of coal as a primary focus. And this focus is, I think, something you have been evolving over the last few years. Maybe you can speak a bit to how you see the MPO as an opportunity in emerging Asia, as well as what are some of the adjacencies, related areas you're exploring as part of ETAF.
Sure. Hopefully people can hear me better now. Yeah. Yeah. So so if I go on from Marat's experience, there's been a fairly long period of us trying to go through a similar journey where we're trying to understand what is an addressable market in the context of what investors want and can invest in, both catalytic and commercial. But I think equally importantly, what does the system need and what are the borrowers and the asset owners telling us, right? So we went with the construct of there is a desire to reduce the impact of carbon intensive energy production like coal and diesel, but how do we get to that outcome? I think after a lot of discussion and dialogue and partnership with MAS and FASP and others, I think where we've landed is essentially creating two components or two sleeves within ETAF. One we broadly call displacement, which is avoiding the creation of coal, and we'll talk about a couple of examples. And two is replacing existing coal assets. And I think both are essentially speaking about a continuum of coal impacting. It's just a point in time view on whether coal is already a part of the energy spectrum or it is going to be a part of the energy spectrum, and how do you manage that? So you mentioned what adjacencies. So the way we think about it is at one end of the spectrum, it's essentially avoiding the creation of new coal assets. Two is working with industry and replacing captive coal assets, or where there's an opportunity to deliver C&I capacity, which is green, compared to somebody who's using captive coal or grid power. The third component of that is what are the enablers for that, which is grid and storage. So we're going to spend a fair bit of time in that space. On the other end of the spectrum is the actual phase out of coal. And again, all the financings that come in and around that, including the very important carbon credit initiatives that the Singapore government and stakeholders are leading. So essentially, it's two sleeves, but looking at energy from an end-to-end, both from avoiding to replacing coal and diesel and energy intensive.
Great. I think, and for the Asian context, both of those make a lot of sense. So thanks for sharing that. Matt, let's come to you now. The industrial transformation pillar. Some would argue it's one of the hardest transitions to accelerate private sector shift to low carbon technologies and industrial decarbonization. It's a particularly hard nut to crack, especially in emerging markets. But again, you've managed to create a lot of interest amongst LPs and funders and partners. I think we heard MUFG, AIA, Nexi, IFC as some of the names that you are working with. So from your journey and from your experience, which industries and which technologies do you see as the most promising for the ITP pillar, and where you feel you can add distinct value?
Yeah, thank you. So for the Industrial Transformation Program, we have focused on three core strategies, three themes within the investment strategy. The first one is industrial decarbonization. These are the easy projects that exist across the region today that we know are there, that just don't have enough funding. And that when push comes to shove, given the amount of capital that's available in the market today, corporates are prioritizing other non-decarbonization projects for the financing that they have available. Think about manufacturing decarbonization, building efficiency, resource management, circular production, waste reduction, fleet and other transport electrification, power generation, including waste to energy and biofuels for industrial use, as well as captive energy storage and management. So Malaysia is a great example of a target market here. Malaysia has energy-intensive industries, make up 25% of Malaysia's GDP. They have favorable regulations that were introduced to make it easier to finance industrial decarbonization and to source off-grid renewables in particular. And they have a national energy transformation roadmap that further enables this shift, so you have the policy support. The second theme that we're investing in is a focus on hard-to-abate sectors, as you said. So this is, the heavy industries and manufacturing that is heavily emphasized across the region. Steel, cement, chemicals, both the conversion of existing infrastructure as well as expanding capacity to build new capacity to a low emission standard. Transport infrastructure such as aviation, freight, rail, and maritime. These are heavy, hard to abate sectors that will take some time and a lot of capital. Indonesia is a good target market here. Obviously, Indonesia is an important source of nickel and other minerals that will be an important part of the energy transition. There's a lot of interest and desire for capital to support mining decarbonization and electrification. We've seen growth of interest in the green steel and cement industries and the opportunity to convert heavy shipping industries and assets. The third theme is emerging decarbonization technologies. So these are the exciting technologies. We spend a lot of time talking about hydrogen, ammonia, CCUS, other carbon removal technologies. There's enormous potential in each of these technologies, but they're going to be slow to come to the market. Now, the organization I work for, Global Infrastructure Partners, is a leader in emerging infrastructure technologies globally. So as these technologies are gaining traction globally, we'll be well positioned to identify the best opportunities to deploy these into the target markets of Southeast and South Asia. For example, India, one of our target markets in South Asia, has a strategy and goals around the generation and distribution of hydrogen and ammonia. And we're seeing some early projects to develop a hub and distribution network for hydrogen, as well as ammonia for export. Now, these three themes in this strategy will help us organize what I consider to be actually a wide opportunity set into specific risk profiles and opportunities that match each of the target markets where we're looking to invest. It also represents a roadmap for us for market development. So as we see more interest and greater sector development and policy focus on things like the hard-to-abate sectors and the policy support for emerging technologies, we start with where we can deploy the capital today, and then we grow into these expansion markets as they develop over time.
Thank you. And if I might put you on the spot and say, of the three sub-pillars that you identified, which one are you seeing to be most promising from an early deployment perspective?
Well, I think early deployment will happen in the first theme, which is industrial decarbonization, because as BlackRock, we have deep relationships with corporate leaders across the target markets. We are almost always present in a corporate leader's capital stack, whether in the public sector, if it's a public company, or through private support in the private markets. And we're talking with those companies about if we had this capital and we were able to deploy it alongside existing sources of financing like banks and multilateral development banks and development finance institutions, what else would you use additional financing for? And understanding the nature of this capital that we're bringing, what are the things that we could work with you to prioritize? And we've seen a tremendous amount of interest. We have a pipeline of deals already, and now we're looking forward to having the capital to deploy. And we've seen an enormous amount of interest, most importantly, from institutional investors who are motivated by the sustainability angle of the strategy.
Fantastic. So thank you to all of you for sharing the next level of detail of some of this stuff, which is not easily available in the public domain. I think your time has already been well spent by being here, and I hope this will also be shared or virtually so that people can get the color and the details of the nuanced thinking that has gone into each of these pillars. So thank you for that. Maybe turning to barriers, because that's what we are here to unlock. As we discussed earlier on, the talk of blended finance is far ahead of the walk, right? And I'm sure you guys face barriers on a daily basis. And there are many barrier conversations, so I don't want to dwell on barriers too much. But maybe just to say and ask you, what is the one single biggest barrier that you have faced, and how you are planning to address that? That would be quite useful. Maybe Vid, do you want to start?
Yeah. So again, if I put this in the context of the South Asia, Southeast Asia region, there is a lot of liquidity in the region. Matt, you'll attest to it that there's a ton of public market liquidity, but we're talking about transactions that wouldn't otherwise be financeable. So the single biggest barrier we see is the ability of local currency capital to mobilize at scale to support the growth of infrastructure in and around energy. And I think where blended finance can play a role is, again, taking one of the examples given was, if we provide enough subordinate capital, which will allow local currency capital to come in and play at scale, that to me is one of the big barriers in the region, and how we can play a role in supporting platforms, individual assets, and individual transactions to mobilize at scale.
Yeah.
There are other regulatory barriers that are linked to this, which I'll get into later, but to me, this is the single biggest barrier.
Fantastic. And as a heads up to Munib, I'm going to come to you after them, because I think some of these you will have to help them solve as the platform. So I'm giving you a few minutes to prepare your answer. But Varad?
In my mind, one of the biggest barriers in the region from investors is actually risk perception, right? And it's often more perceived risk rather than actual risk. It perhaps, if we're very financial about it, we can call it unpriced risks, risks that the pure commercial players do not know how to price properly. And so the result of that is either there is no, even the capital is there and the liquidity is there, either that capital does not flow, does not express an interest in an investment opportunity, or offers terms that are so wild that they just don't work in the context of the economics or the reality of the project, right? And I think this is where the blended finance constructs that all of us, I should say, are working on, and all the different capital stacks that we're putting together with this first loss layer, I think that helps with this risk perception aspect, because ultimately what these capital stacks create is a layer in the capital structure that insulates commercial investors from these risks should they actually materialize. And through executing on the strategy, through deploying capital, the demonstration effect that we're all, and certainly as Pentagreen, are aiming for, is to show that perhaps some of the perceived risks that are there up front, that are there ex ante, ultimately may not materialize. And the situations, the companies, the mid-market space, the growing developers, the entrepreneurial developers that we see a lot of in the Southeast Asia region, when they can take credit, when they can take funding from the likes of Pentagreen and eventually others in the market, that actually these are good deals to be done. They generate good, sound risk-reward, and they can be done perhaps after a few years by pure commercial players alone, without any blend. So the blend just gives it that little bit of an extra nudge by helping to insulate commercial capital from some of the perceived risks that might be there.
I think that's fantastic, and I think just if you could just play the role of reducing that gap, like you said, between real risk and perceived risk. It's great, obviously, for each of your pillars, but I think it'll be a major unlock more broadly, because this is a topic that keeps coming up in the context of emerging markets everywhere. Matt?
Yeah, so I agree that mobilizing institutional capital at scale is the hardest problem to solve. I think part of it is using blended finance to overcome that initial barrier and hesitation to invest. The other part is developing a fund strategy that presents a like-for-like portfolio of assets to what investors are already comfortable investing in developed markets. And so for us, what we're focused on is a fund structure, a commingled fund structure that looks similar to what all of our clients already invest in developed markets. And we've seen over the last couple of decades, institutional investment has moved into infrastructure globally at such strong scale, and it doesn't compete on terms with existing sources of finance or commercial banks. It doesn't replace existing capital that's available, but it comes in as a partner and helps scale up the amount of infrastructure that can be privately financed. And there is tremendous need around the world for those kinds of investments. So here, what we want to do with this strategy is we want to prove, number one, that this is an investable market and that there's a large pipeline of private sector decarbonization projects that are worth investing in. And number two, that the investment experience that an institutional investor can get in the strategy is comparable to the risk profile that they would see in a developed market strategy. And we use blended finance to get through the first couple of vintages of the fund, and then by vintage 3, we don't need the blended finance anymore. We don't need the catalytic capital anymore, and we have created a market that can generate significant scale from the core books and allocations of our institutional investors.
Fantastic, and I think that's really where speaking the language of the investors is where you guys come in. And I think links to the point, Munib, you were making earlier about FastP's uniqueness of having picked fund managers that people understand, relate to, and can speak their language. So I think they're doing a lot of stuff in overcoming these barriers. But I'm sure this is also a question that keeps you up at night. And how are ways in which the platform, the FastP platform, can support overcoming some of these barriers? Because not everything can be solved in a pillar or a fund construct.
Sure. So this, you can hear? Yeah. Okay. So this is the biggest problem. Not many people can hear blended finance story. They can hear it, but the messaging is not correct. One thing that we've learned, or I've learned, and not coming from a blended finance background, I myself have been a fund manager for 30 years, so I know how fund managers think and operate, and that's maybe why I have this role, to keep them honest. But I think the blended finance narrative has been created historically, traditionally, from a multilateral development bank's perspective or a DFI's perspective. It's always been on a project by project. It's never ever been created. The storytelling is not right. And for me, that is the biggest, you could say, obstacle we have for blended finance, is that when we go and, let's say, pitch to a pension fund in Australia, the language we use is still being used, is the same language we used to use for getting a catalytic capital provider to put money in. It's about additionality, it's about mobilisation, it's about impact. And these folks we're speaking to, they care about risk return and de-risking and the rest, right? So the blended finance messaging has to change. And that's where, like, these folks have found a problem to solve, and they're doing it in a good way. For us at the FastP office, there's three things that we're going to focus on. And that is, we need to help innovate with all these gentlemen here and their organizations. Secondly, what we need to do is simplify. Hopefully by the second, third, fourth fund, the structure, our architecture, everything is much understood by all the private sector. So the narrative becomes easier to understand. And then the third one is communication. We cannot have sounds from everywhere else like that coming in our way. We need to communicate in a much better, clearer, consistent manner. And that's something that FastP is going to be doing. And that person is testing too much. He should stop the testing.
Fantastic. And maybe just building on that a little bit, Munib, it's often in this space, people talk about this concept of ecosystem building, right? And DFIs and MDBs, that language you're saying, right? So, and there's a lot of discussion on the fact that, not just money, you need a funding plus approach. And, in some cases, funds are trying to do this directly by, say, taking controlling stakes in large investments and then trying to build a value chain or ecosystem around it. In some cases, folks are engaging with what are now becoming called country platforms, where governments are taking the lead, putting together country platforms as well. How do you see the role of FastP in terms of this ecosystem building for a lot of these areas that the pillars are working on?
Sure. So I think even the three things that I mentioned, innovation, simplification, and then communication, that in itself requires a lot of partnership. So that in itself does create a bit of ecosystem building. But at a different level, even in the story and the journey that Marat was sharing, and the journey that we're going through with Vid and also with Matt now, we are speaking to service providers from lawyers, accountants, tax consultants. We're dealing with regulators, policymakers. We're dealing with academics. We're dealing with a lot of people who are learning. Every time a deal gets done, like the first close of GIP, you find there's a new, there's a creation, deepening, strengthening of the ecosystem. So I think every deal and every fund manager and every fund that we close will create that influence. But I think even on a ground, the ecosystem gets created just by being in a room like this. As an example, in Sao Paulo, myself and Joyce, we were at a convergence get-together on blended finance, and we shared FastP and what it was doing. When it finished, the first people who walked up to us was an FMCG, global FMCG that has operations in Indonesia, and they said, how can we get in touch with your fund manager because we need greening of our supply chain? Just there and then, we are seeing ecosystem being created. I think a better example, and I'm going to pass this on a baton on to Matt. Matt and what they're doing with ITP is something really amazing on their ITC.
Thanks, Munib. So I think what's great about FastP is, number one, we all get to work together in collaboration and partnership. And number two is it really supports the growth of Singapore as a sustainable finance hub. And to be able to lead deployment of capital into this region from Singapore helps to build that local ecosystem as well. And we've expanded. BlackRock today has 750 people located in Singapore. We're expanding our investment team in order to facilitate direct origination in these markets, and it's a big growth priority for us, as well as participating in this growing ecosystem in Singapore. On what Munib said, the Industrial Transformation Council, our partners in our strategy have all asked us, what else can we do? We're going to invest in your fund, we're going to deploy capital, but is there more value that we can get from being a part of this partnership than just the deployment of capital? So we developed what we call the Industrial Transformation Council, the other half of the Industrial Transformation Program, which is going to bring together investors, corporates, policymakers, DFIs, and others who all have a shared interest in facilitating the greater flow of capital into these target markets. They're going to do three things. Number one, we're going to move beyond just the deployment of capital in through the fund itself to look at other deals that haven't been able to access financing, to look at deals that other partners around the table are doing to help bring co-financing and co-investment across a wider range of investment opportunities. Number two, we're going to highlight solutions. So we'll bring in corporates who have industrial decarbonization technologies. We'll do some matchmaking. We'll highlight solutions that are being developed around the world that we're seeing in other markets where we invest and where our partners also have familiarity and expertise. And number three, we'll engage in policy dialogue. And I think every one of the partners around the table does this and has good relationships in the target markets that we're looking to deploy capital. But the power of having fund managers, large, deep asset owners, corporates who can enable and desire that capital, as well as the policymakers around the table together, I think can be a really powerful enabler to accelerate the policy conditions necessary to enable further investment.
Good, you want to...
So if I can go next, I think maybe I'll pick 2 or 3 specific examples on where Singapore, I think, can and is playing a part in the ecosystem building. So one is on regulations. I think Matt made an interesting point on how you deliver investable product in developed markets can work in emerging markets. And what do investors typically like? Rated transactions. So rated funds, rated notes, securitizations is one example. Delivering it to investors in a way that's capital efficient, so insurance investors, etc. So that's one area where I think MAS is taking a lead role in the region in a thoughtful, consultative approach to not just take rules from another jurisdiction and implement them, but just make them match fit for the region. So I think that's a huge game changer for the region as that gets embedded not just within Singapore, but across the region. I think the second example I'd give is maybe an entity like Infrastructure Asia, which is just taking this one step beyond and saying, how do I take standardization of taxonomy, standardization of how a PPA is written, standardization of contract frameworks, etc., etc., etc. Because what I think we all like is replicable, repeatable, scalable transactions. We don't want to reinvent the wheel for every single transaction. And I think success for us is just being able to rinse and repeat rapidly.
Fantastic. I already feel like, as a consultant, I want to make a slide right now on like how the funding piece and the ecosystem piece are like sort of, working together. And I think, see, these examples, I think at the level of the pillars, like you talked about, Matt, setting up that group, the role folks like MAS and Infrastructure Asia can play to be that enablers and connectors. And of course, as you announced earlier, Munib, your own international advisory board now, which has been set up, which can play a massive role in this ecosystem piece is really the way to go. So I shall think about the slide and share with you later. I wanted to get some questions from the audience. But I know that it takes... Okay, great. We already have a question. I was going to give you a few minutes, but since you already have a volunteer, let's go for it.
I had a microphone just matriculate out of thin air, so that's great. Jackson Ewing, Duke University. Thanks for the panel. 2 quick questions.
Sorry, Jack, could you just reintroduce yourself?
Jackson Ewing, Duke University. Vid, first for you, can you say a bit more about how the different coal transition credits are affecting your investment decisions, whether it be MAS showing up as an off-taker, whether it be ADB's ETM, whether it be Energy Transitions Accelerator, are these really affecting your calculations at all? And Marat, from your first transactions through the FAST partnership, what can you say about the different parts of the physical value chain where catalytic capital is most needed? Like, you all talked about the Philippines energy sector. Well, the DOE in the Philippines will tell you quickly that they can get private capital for generation. They have trouble getting capital in for grid upgrades and interconnection and things like that. So how do you circle that square? Thanks.
Can we maybe take one or two more questions, because we might run out of time otherwise? We can take them as a group and then go through, and all of you can decide and answer a few of those that are relevant to you.
Hello.
Please.
Hi, Tomo Ishikawa from MEFG. Thank you very much for the great discussion. So maybe this is more for a question for Ambassador Ravi, but you mentioned that your catalytic capital, it's not, you don't, basically you're not expecting to be repaid, which I think it's a great way to catalyze capital. But it means if I'm a Singaporean, I may think my tax is basically exposed, and I understand the capital will not be only invested in Singapore, but throughout Asia. So how do you justify when the beneficiary may not be in Singapore, but somewhere outside of Asia? How do you kind of justify that conversation? Because at the end of the day, I think what you need is similar program outside of Singapore as well. So that's one question. Second question, related one is,
You can pick one question.
Okay. How do you create synergy with your, but Ravi, you also mentioned about JETP and other initiative, because at the end of the day, you don't want all these initiatives to compete. So maybe a related question, but thank you very much.
Fantastic. These are very profound questions. They could take a long time to answer, but let me see. There's one more question from the group. Then we can take them together.
So, Gulshan from Global Green Growth Institute. I want to pick up on the standardization part. I think, Munib, you picked up on creating ecosystems and once. I think way too much effort and resources are spent on creating project structures that are then investable, blended finance structures. How close do you think are we to creating those standardized structures, which was what Vid mentioned right at the end, and about rating those structures so that the investors, like all of you, can put in money more quickly and at scale and probably replicate for hard-to-abate sectors, let's say?
Great. Maybe let's go around the group, and you can take whichever ones you're most suited to. And then I'll request Ambassador Ravi to take on that question as well. Yes.
Sure. Sure. Maybe I'll just very quickly address that question on standardization. And I think it's, at the end of the day, it's everybody has a different approach. But the way I think about it is partnership. You have to find the right partners who are asset owners, who are willing to work with you. And success does breed success. So through trial and error, we've, for ETAF, gone and taken a couple of different approaches for origination. What eventually seems to be working is finding a small cohort of partners who are willing to spend time with us to answer the simple question that Ambassador Ravi said, which is, what are the deals that aren't getting done? So there's a ton of liquidity in India, there's a ton of liquidity in Southeast Asia for conventional bankable green assets. So I think finding the partners who will work with you, not for a single asset, but then try and create a portfolio effect, is a better way for us than going and trying to do deal by deal. So I think it's partnership and asset ownership. And again, for instance, GIP, the equity side of GIP is a fantastic partner for some of these conversations. And quickly on the question, which I'm not forgetting on, and I'm happy to step offline and give you a more comprehensive view, is there isn't a single answer to every archetype in that space, because every single transaction has different connotations on what the payback profile is. Meaning, what is it that's paying back the commercial capital and the blended capital? Is it credits? Is it concessions? And what mix of that? How much of that is going towards just transition, etc.? So I don't think there's a specific answer we could say, here's a framework that works. That is probably one of the areas where standardization is unrealistic. So each transaction will have to be looked at it on its own merits.
If I may, and I'll answer the questions of also the same two gentlemen, if I may. I think on the standardization point, I think what's quite interesting right now in the evolution of blended finance over the last few years, this is my take as to where we are in blended finance. A few years ago, the attempts and the experiments were really being made on a project-by-project basis, which had its role, right? I think that's a completely valid approach. It has its limitations as well. Therefore, all of us collectively, as a blended finance industry, as a market, we're now in a place where we're trying to do things much more programmatically on a platform level, on a fund level. You see 3 such attempts here today. The constructs are looking similar, but they have their own nuances. And this is the market and us as an industry experimenting and iterating and finding our own product market fit, if you will, right? Which will take a few of these constructs to be transacted, to be implemented, to be deployed. And then, of course, market conditions also change. The next set of iterations perhaps will have to look a little bit differently. Maybe there's more simplification. Maybe there is a change in how the different tiers of the capital stack works. Perhaps it's a different set of partners. But really, this is what it's about. Testing, transacting, more vehicles being put to market, being launched, those vehicles starting to deploy. And with this, a market and an industry, and eventually what we might start calling a blended finance product is created for institutional investors and commercial investors. And if I may, there was a question on how is the capital used, where is the need for this kind of capital, why is there a need for blended capital in a place like Philippines? At least that's how I understood the question. I think what's very interesting and what's happening in even the more mature markets of developing Asia, these are still, I think, from an institutional investor's perspective, considered emerging markets. And emerging markets allocation or allocations are almost by definition scarce. Institutional investors do not like emerging market risk. It's almost dogmatic in some cases. Even though we have countries like Philippines, which is actually an investment-grade country. India, it's an investment-grade country. Indonesia is an investment-grade country. And you might see companies within each of these countries, credible companies, maybe they're still in their growth phase. They can perhaps get capital from project finance banks up to a certain level. They can perhaps get equity capital up to a certain level. And what we're finding in the transactions that we're funding, we've got 2 transactions in Philippines. Both of them exhibit this issue where there is still a gap in the capital stack, which neither equity is ready to fill and nor the commercial project finance bank. And really, the only solution for that kind of capital gap, it appears in the market today, is some form of a blended construct. And what that does is it helps this company complete the capital stack that's needed to accelerate their pipeline implementation and really move from a stage where they are somewhat nascent, growth stage, move to a stage of much more maturity where they can attract pure commercial capital day in, day out, banks, equity, bonds, capital markets, many more financing options open up to that kind of company. So it's about finding these gaps that continue to persist in the market.
I'll just add one thing on standardization. When I first started talking about blended finance 15 years ago, the public sector actors and the private sector actors spoke completely different languages. And the fact that we can have this conversation today, the fact that we can sit down across the table from each other, trust each other, work together on a strategy, bring the best of both sides of the table together in one strategy and align on the terms and conditions of that really makes this a golden opportunity for blended finance. And the commitment of significant capital from governments like Singapore and other DFIs and the MDBs who now face the significant private capital mobilization pressure makes this an opportunity that we have to take, and we have to do it at scale, and we have to keep it simple so that investors understand what the objective is that we're trying to achieve. If we can do that, we'll succeed. If not, we're going to miss this moment. And I think this moment only lasts for a couple of years, so we really have to take advantage of it now. On the question about building coalitions and partners, so what we have tried to do with ITP is develop a clear investment strategy with a clear investment pipeline that stands on its own, even though it fits into this larger jigsaw puzzle that is FAST-P. It was designed in partnership with the government of Singapore as part of FAST-P, but what we discovered when we looked through, for example, the AZEC agreement from the Japanese-led initiative is that this investment strategy actually aligns very much with what the AZEC leaders in their statement called for the deployment of capital into. And so by being clear about what the opportunity set is and how we're going to mobilize capital and deploy into that, we can build bigger and bigger partnerships, and we can use these vehicles to bring more players in, more actors, more partners, and ultimately 1 + 1 really can equal more than 2. In this case, hopefully 4 or 5, by having a number of key partners who feel like this investment strategy also aligns with the goals that they have and the leadership role they want to have in the region.
Sorry, just before I pass it on to Ambassador Ravi, the FAST-P as a platform take on standardization. At the beginning, I started with this myth that we wanted to bust, right? That, it's like herding cats, the catalytic. I think there's one myth. I don't think we should ever expect that there's going to be one archetype blended finance structure that everyone will sign off on. That is not going to happen. That's the bad news. The good news is that the only folks that are really needing to get together is the catalytic capital providers. And a lot of the conversations we're already having at FAST-P is we're finding that we are almost, all of us are seeing similar deals, similar archetypes of blended finance structures, and often we at FAST-P have regular sit-downs, collective sit-downs with catalytic capital providers, and we almost dissect different other, you could say, structures, and everyone's getting to know them better, everyone getting to understand them better, everyone knows which partner will be actually suitable for a certain blended finance structure. So there is a coming together of a lot of the catalytic capital providers, and they might join you on this blended finance structure, but they will not join you in the other one. And the good news is that collection of catalytic capital providers coming together and discussing and knowing each other well is happening. With that,
Ambassador Ravi, would you mind saying a few words?
Yeah, I wasn't intending to, but I've been dragged into this. The two questions. One on why is Singapore doing this, right? It's taxpayers' money.
Could you go closer to the mic a little bit?
Okay, yeah. It's like this. As we observed throughout the discussions today, climate action is collective action. We need to take concerted actions. We need to work together across countries. So the question that the Singapore government had was simply this. If we have to contribute, what is the best way in which we can contribute? We have to contribute, right? There is so much decarbonization that can take place with the right amount of financing. And then we decided that rather than just contribute to a pot of money to be deployed, why don't we do the hard work of setting up a structure like this to crowd in capital and multiply our efforts. And let us not forget, everything that we do to decarbonize, when Matt or Varad, when they do a decarbonization project in some other part of Asia, they're helping Singapore. Because let's not forget, a ton of CO2 emitted in Indonesia, in Vietnam, in Brazil, and in Singapore has the same effect on the climate. So we got to ask ourselves, what is the best use of our money? And whether it's carbon credits or whether it's blended finance. If we can maximize the reduction in CO2, it's good for all of us. Singapore benefits when we contribute to decarbonization elsewhere. Now, we're not doing it alone, and we have no illusions that we're going to solve the problem, but we are contributing to that. I think that is the basis, and I think that makes a lot of sense for how we use our money. The second question, now that there are a few blended finance structures, are we competing? Are we... Actually, on the contrary, there are not enough. We need at least 10 times more. We need much more. Our balance sheet, if we succeed, is to build up to $5 billion. Now, you know the amounts of money that's needed each year for climate finance. Much, much more. We are trying to set us an example so that others will also do similar structures, and we can multiply these effects even more. So we want to demonstrate that this works, and others also come on board and do. So there's no competition in this. And I think there is also less risk of fragmentation because the trend in the blended finance space is already towards platforms and programs away from projects. The next big step is whether the platforms and programs like ourselves and others can get together and talk about issues like standardization, consistent approaches. So that is part of the plan. But we need more such players, and we need them all to weigh in. But we can probably now start to think about how we can achieve some degree of alignment in our approaches so that it becomes easier for both the commercial investors and the catalytic capital providers to participate in these structures. So that's how I would look at it. Yeah, thank you.
Thank you, Ambassador Ravi, and I think it's a very uplifting note from you to sort of sum this up. But I'm going to take moderator privilege and take another couple of minutes and ask a last question to all of you. Oops. Before we get shouted down by that group. I think, you guys have told us a lot about your journey and we have a rough idea of where you guys are heading. But if you had to put your neck on the line and say, 3 years from now, when we are at COP30, which, by the way, is most likely to be in Asian soil, fingers crossed, where would you like your fund to be? 60 seconds to all of you. Matt, maybe we'll start from you.
Well, we'll be in a future vintage of the strategy at that point, which will be exciting. We'll be deploying capital. We'll have a strong pipeline of opportunities across the region. And I think most importantly for us, we will have a coalition of really engaged partners who all have rolled up their sleeves and are actively working together. And I'll put in the plug. I hope many of you in the room will join us.
Fantastic. Varad.
In 3 years' time, certainly deployment for Pentagreen is already happening. Projects are being funded, deals are being closed. The velocity of deals is high, so that will continue in 3 years' time. I'm sure out of the capital pool that we're fortunate to have available to us right now, we would have deployed the vast majority of it by that point, I have no doubt. And of course, the future iterations of this program, because all these capital pools that we're talking about today are indeed up to 5 billion only, and Asia's sustainable infrastructure needs are, we love the trillions of dollars when we talk about the market gaps in Asia. So the needs are huge. More vehicles are required. But the ultimate hope, ambition, and vision is that more and more investors, whether that's from the developmental world or from the commercial and institutional world, start to see blended finance as a theme, as an allocation, as a product that they can readily deploy capital to in short time frames.
Fantastic.
I'll probably use the word that Matt used again, vintage. So if we're talking about that and we're talking about ability to replicate and mobilize at scale, some of the things, I have a board member here and I'm more worried about my CEO on board more than what FastP will say, because they'll hold me to this. I think it's about trying to create partnerships in time. And when I say partnerships with both investors and asset owners, to go and say, here's a pipeline. Does somebody want to fund a pipeline, not a fund? I think that to me will be success in 3 years' time.
Fantastic.
Okay, with a name like FastP, whatever ambition I give, we will have to beat it. So I'm not going to give an absolute ambition. What I'm going to do is set the pace ambition. So whatever we're doing now, we want to do that in half the time in 3 years' time. It's almost like we want to be that pace setter in a marathon run. We have a group of people around us who are running at a fast pace and sustaining it for the final finish line. So yeah, that's what we want to be.
Thank you, Munib. I think it's a great note to conclude this. Lots of P's have been bandied today. Pipelines, partnerships, platforms, projects. But I want to being an observer of you guys from a little bit of a distance, I want to thank you for 2 other P's. One is your positivity, because this has been an unlocked conversation and not a barrier conversation. And the second is your patience, because I think this is not an easy space, despite all the smiles that you're giving, and you're at it with the resilience that you are doing. So thank you for that. I want to end with a very quick quote, because I started with a quote, and this one is from Lee Kuan Yew, who of course needs no introduction in this pavilion. And he said, and I quote, "There's a glorious rainbow that beckons those with the spirits of adventure. And there are rich findings at the end of that rainbow. Look at the horizon. Follow that rainbow. Go ride it." With that, thank you, ladies and gentlemen, and thank you to our great panelists.
Thank you very much. We would like to keep Varad and everyone, please remain on stage. We'd like to invite Ambassador up on stage as well to take a photo op, please. Thank you very much, and hope everyone had a very fruitful discussion. Okay, so if you'd like to find out more and follow our updates on FastP offices or developments, kindly scan the QR code on the screen now and follow us on LinkedIn. Thank you very much once again.